We would like to produce a comprehensive series on the stock market, often known as the equity market. A video that introduces some fundamental concepts regarding the stock market is planned. We are hoping for your support. Tell others who are interested in the stock market and those who wish to learn more about the equity market about this video.
Hopefully, this video will be useful to you. So don't wait and get started right away. The stock market as a whole is an exchange mechanism that helps investors buy and sell shares in publicly traded companies.
Let us understand what stock market is and how it works with a simple example. Ramu is a businessman. He sells a special flavored tea. He starts this venture with 10 lakh rupees in hand. People like his tea very well. Therefore, Ramu is able to sell more tea and make huge profit. So going forward, Ramu wants to make his business bigger. Ramu starts more outlets with his profits. 2 years later, Ramu's firm has grown from 1 outlet to 10, and the company that began with 10 lakhs now has a value of 1.5 crores. After realizing that only reinvesting the income would not expand the business, Ramu considers ways to raise capital. To raise more capital, Ramu can either take a loan from a bank or bring in a partner or raise money from the public by listing the company on the stock market.
If he takes a loan from the bank, he has to repay it and pay interest on it. If a partner is brought in, he should be monitored to see if he is doing things correctly. The special recipe of tea will have to be shared with him. Finally, Ramu decides to raise funds from the public by offering certain shares of his company to the public. Imagine that the value of the company is 3 crores when Ramu decides to issue the company's shares to the public. 1 crore shares are issued by Ramu. Ramu now owns 1 crore shares. Ramu decides to raise funds by giving 30% shares to the public.
Since the value of the company is 3 crores, and the number of shares issued by Ramu is 1 crore, the price per share will be 3 rupees. Ramu collects funds by giving 30% of 1 crore shares worth 3 rupees to the public. That is, 90 lakh rupees are raised by giving 30 lakh shares to the public.
A person who buys a share of Ramu's company pays 3 rupees for it. Let's see what benefits he gets from it. A person holding 1 share gets an ownership interest in that company proportional to that share. Here a person holding a share in Ramu's company gets 0.00001% ownership in the company. Let's understand more with another example. Suppose another person holds 1 lakh shares. He pays 300,000 rupees to buy that number of shares. The company has a total of 1 crore shares. Out of that 1 crore, 30 lakhs can be bought by the public through the stock market. We have said that a person buys 1 lakh shares out of those 30 lakhs. Now he holds 1 lakh shares out of the total 1 crore shares. That means he holds 1% share of that company. Ramu sold 30% of the public's shares on the stock market, as we previously stated. Since then, Ramu has owned 70% of the business and the remaining 70% of the shares. We hope that you will comprehend it.
Currently, Ramu's company is worth 30 rupees per share, but if it goes up in the future, those who are holding it now will get profit from it. But if the stock price goes down, those investors will also lose.
Let's take Ramu's business again as an example. People believe that Ramu's company will grow well in the future. People get news that the business's profits and customers are increasing, so people buy the company's stock on the assumption that the company will generate good returns in the future. Here the demand. Suppose there is a negative news about Ramu's business. Everyone who holds the stock tries to sell it, and as a result the price goes down sharply. The price is determined based on the law of supply and demand. In short, if people buy more, the price of the stock goes up, and if people sell more, the price of the stock goes down. We can talk more about these factors in later videos.